determine your exit strategy. There are two possibilities for your exit. You can turn a property quickly after increasing its value by selling it at retail or seller financing it to another investor. Secondly, you can refinance it and rent it to your tenants. Now, that $2.6 million 22-unit building that I just showed you, we bought it at 2.6. Once I get the rents increased and the property renovated, that property was run down. We bought it intentionally to fix it up. I didn't raise $2.6 million to buy that. I raised $3.2 million to buy that. We over-financed it, so we had enough money to cover not only the debt service, but also the renovation on the asset. So we come out of pocket nothing. We put $250,000 in an account, and we go to work on that thing. Now, the best part about that 22-unit apartment building, guys, we had investors who were able to get involved in that and participate in real property ownership without having to do any of the heavy lifting, any of the work. And within 12 months, they will have 60% of their total investment returned. And within 36 months, they will have 100% of their total investment returned. And they will still maintain ownership interest in the asset as it spins off continual cash flow. Now, this is one of the strategies that I will be teaching you at the upcoming certification training class. Now, understand that it's always a good idea to have more than one exit strategy so that if one doesn't work out, you can fall back on one of the others. Now, some benefits of buying and holding. Cash flow. This is the income your property generates on a monthly basis via rent payments. Leverage. Investors often miss this. If you reinvest your cash flow, tax savings, and rent appreciation, your money grows quickly. And your cash flow properties can provide for new assets, which in turn yield more cash flow. Now, this is the share. Equity is the share of the property you own. You can gain equity in one of two ways. You gain equity when your tenants pay your mortgage over 15 or 30 years, or you gain equity when the property appreciates. Now, guys, since 2009, when the market crashed, we have never, since that day, bought property based on future appreciation, based on future value. And you should not begin, even today, incorporating that into your analysis of cash flow. Do not anticipate any appreciation during the ownership of these assets. Focus everything you do on income. What is it worth? What are we paying for it? What are the rents? What are we getting? What's the cash flow? If you're going to keep it for 10 years, I could care less what you think you're going to sell it for in 10 years. It does not affect what is important right now, and that is, does the property cover its own expenses? That's all we need to worry about. Future value is that. It's in the future, does not affect our paycheck or our pocketbook today, so it's irrelevant to the process, okay? Tax savings, depreciation, one of the biggest benefits to real estate investing because it can reduce reportable net income and therefore your taxes. One of the reasons that as a company we've been going very aggressively towards buy and hold assets is for that very reason, to offset the burden of capital gains because we've been flipping so many houses. I mean, we will flip over 200 houses this year, but we're also going to acquire 250 properties to buy and hold. So tax savings is a huge benefit of this process. And then lastly, as it relates to cash flow, is rent appreciation. As inflation continues to rise, and it is anticipated to continue to rise, so will rents increase. So the McDonald's worker who's really excited that they're not getting $11.50 an hour anymore, they're getting $15 or $16 an hour. Well, guess what? At $11.50 an hour, their monthly rental rate was $7.50 a month. At $15, $16 an hour, their monthly rental rate is $1,100. So they didn't increase any gain. They simply got a rise in monthly payment or hourly wage, but then all their costs went up. So the net is the same. So inflation, don't get me started. They're not getting ahead. But you are if you own rental property because you are skirting or avoiding inflation because a rising tide lifts all boats. So property values rise, rents rise, the value of your asset increases, and while yes, your expenses go up, so does your ability to write those expenses off on your taxes. A lot of you here are not business owners. Let me tell you, one of the best businesses you can start and keep is simply buying a multifamily or a single family home and turning it into a rental. That is a business. And with a business, you get write-offs, you get depreciation, you get deferred interest, you get all these benefits the minute you buy and hold rental property.